Hi, I'm the Tax Geek, and this is more of your taxes oversimplified. Today we're going to take a look at 401k plans and how they work. First, we'll answer the question that many of you don't have. Why is it called a 401k plan? Simple, because the structure of the plan was originally described in Section 401k of the Internal Revenue Code. This section of code was written in 1978, but it wasn't until the mid to late 1980s that the plans became popular. It wasn't realized at the time, but 401k plans would entirely reshape how people would save for retirement and how companies would fund retirement benefits for their employees. This video will refer to these types of plans as 401k plans, but plans such as 457 plans and 403b plans work very similarly, but for different types of organizations. This video will also focus on traditional 401k plans. Roth 401k plans will be discussed in another video. So the next question is, how do 401k plans work? First, a 401k plan allows you to divert part of your wages into a company-sponsored account for retirement. These diverted wages, or contributions, are not subject to federal or state income taxes. The contributions are, however, subject to both Social Security and Medicare taxes. You can divert as much as 100% of your wages into the plan, up to an overall limit of $19,500 if you're under age 50, or $26,000 if you are age 50 and above. The company may then match part or all of your contribution. Rules for matching contributions vary from company to company. Some automatically match your contribution dollar for dollar up to a certain percentage. Others will make a discretionary matching contribution based on company profitability. The overall requirement of any matching contributions is that they not favor the highest paid employees in the company. In some 401k plans, company matching contributions immediately become the property of the employee. In other plans, employer contributions gradually become the property of the employee using a process called vesting. This vesting period can be no more than 5 years. Just as your contributions are not taxable to you, neither are the employer's contributions to your account. So, participating in a 401k plan and receiving matching employer contributions is, in effect, like getting a tax-free raise. What makes 401k plans different from the retirement plans that came before them is the ability for the employee to direct how the money is invested in their account. A company's plan will offer several different types of investments, ranging from low or no risk money market funds to company stock funds, which usually have the highest risk. If you're uncomfortable with investing, most companies offer target funds, which adjust your level of risk as your projected retirement date nears. As a result, your account should grow over time, and if you start in the plan early enough, you can amass a surprisingly large amount by retirement age. When this money is withdrawn after age 59 and a half, you pay federal and state income taxes on the money as you withdraw it. So you might be saying, I don't plan to stay with the same company until I retire. What will become of my 401k when I leave the company? First of all, the amount in your 401k is yours to keep. Your company or the plan administrator will offer you a few options. Some companies allow the money to be kept in the plan, where it will continue to hopefully grow. You must usually have a minimum amount in your account to take advantage of this option. You can do a rollover into another tax-advantaged retirement account, such as an IRA. If your new employer allows it, you might even be able to roll over your 401k balance from your former employer's plan to your new employer's plan. The mechanics of rollovers are complex and a story for another time. They must be executed carefully to avoid taxes and penalties on the rollover amount. And finally, you can simply close out the account and receive the money in it. Companies will often do this automatically for small balances. You will owe tax and penalties on any money you receive. So that leaves the question, what if I need the money in my account before I retire? First of all, these plans are primarily retirement investment vehicles. You should consider other alternatives if you need money, and withdrawing funds from your retirement accounts should be your last resort. If you do withdraw the money early, you will owe both income tax and a 10% penalty tax on any money you withdraw. There are very specific circumstances where the IRS will waive the penalty, including separation from service after age 55, converting the account into equal monthly installments, death or disability of the account holder, medical expenses exceeding 7.5% of adjusted gross income, and domestic relations orders or IRS levy of the account. Circumstances where the penalty will not be waived include down payment on a home, incurring higher education expenses, or unemployment or general hardship. Withdrawing a large amount from a 401k plan can also result in increasing your adjusted gross income to the point where you may be ineligible for certain tax credits and deductions. If you must access your retirement funds, many plans offer a loan provision. This allows you to borrow from your retirement fund and pay yourself back with interest. But keep in mind that if you end your employment before the loan is paid off, the remaining balance will automatically be converted into an early distribution, and income tax as well as the 10% penalty will apply. And that's a quick rundown of how your 401k plan works. Additional information and resources are in the links in the description below. If you found this video informative, please give it a thumbs up and subscribe for more content. Please share this video with anyone who might find it useful. If you have any questions, comments, or suggestions for future videos, please leave them in the comment space below. Thanks for watching, and I'll be back soon with more of your taxes oversimplified.